Jai Shri Ram, Shri Gurubhyo Namaha. Hi guys, welcome to our first lecture in Section A, Part 1 of CMA US, which is Financial Statements. So your Section A of your Part 1 is talking about external financial reporting decisions. So if you understand this properly, external financial reporting decisions. So this is regarding the financial reports that are being prepared. Why do we prepare the financial statements for? For taking decisions based upon those financial statements. Let's say I want to invest in Reliance. So the first thing that I would look is Reliance company making profits or not? So how do I know whether a company is making profits or not? By looking at its P&L statement. Similarly, if I want to buy shares of TCS, I want to know what is its net worth. Okay, what is its total assets and what is its total liabilities, how much cash do they have in the bank, and what are the net worth of that particular company. If I want to know, I have to look at its balance sheet. If I want to know the flow of funds in that company, like from where are they getting the money and where are they investing that money, what are they using the money for, I would have to look at their cash flow statement, right? If I want to see whether the net worth of the company is growing or reducing year on year, I would have to look at their statement of changes in equity statement. So if I want more details about any of this, I would have to look at the notes to accounts. So basically, to take any financial decision, economical decision regarding an investment in a company, we have to look at the financial reports that are prepared by that particular company. Who is going to take those decisions? An external person, an investor, or whoever it is. So your section A covers external financial reporting decisions. So entire section usually depends upon the financial reports that are prepared. So if you see, what I have done is, at the beginning of each section, at the beginning of each topic in a section, A1 talks about financial statements, A2 talks about your various assets, liabilities, valuations, disclosures, and all that stuff. So in A1, what are the learning outcomes that are expected to be prepared by the student as per your loss statement given by IMA, learning objective statement? So what are the learning outcomes in A1? I have given a list of those items at the beginning of the lecture itself, beginning of the material itself. So you can see, so for A1 topic, you are expected to know how to identify the users, demonstrate the understanding of the purpose and use of each financial statements, what are the major components and classifications in a statement, limitations of the financial statements, how are they all connected with each other and how are they going to interact with each other, and relationship among the financial statement, understanding of how these financial statements are prepared. So like this, these are the expected learning outcomes from this section A1. And then after that, you have your integrated reporting, which is the next part of A1, integrated reporting. So what are the advantages, disadvantages, what are the components of integrated reporting, and all that stuff. So like this, at the beginning of each chapter itself, you know what is the expected learning outcome from that particular chapter. So first, let's start with the first topic in A1, which is A1.1, regarding an introduction to the financial statements. So sir, we all know what are financial statements. We have been doing these things since our +1, +2, graduation, first year, second year, third year. We have been doing this a lot, so I'll try to keep it short and clear. So the financial statements are nothing but your final accounts. You used to call them in your +1, +2. Final accounts. That is a not technically correct word. That is not a technically correct word. Financial statements. Sir, what is the difference between a statement and a account? So understand this. Suppose if I'm drawing my trading and P&L account. So in your +1, you might have used trading and P&L. So there you used to draw like this, a trading account, right? So your trading account would start with two opening stock, two purchases, two direct expenses, two factory expenses, etc., etc., then total. On the credit side, you have by, again here you will write debit and credit also if you are more formal, and by sales minus sales returns, by closing stock, any other by direct incomes if you have any, commission, etc., etc. Then if the balance is on the debit side, it's to gross profit. If it is on the credit side, by gross loss. Then this will be carried on to your P&L account, right? So P&L account also You'll have again debitor, creditor. The balancing figure comes to here by GP or to GL, then to indirect expenses, by indirect incomes, then total, then to net profit balancing figure, or by net loss balancing figure. These are your accounts, my dear friends. These are accounts: profit and loss account, trading account, a T-shaped ledger being prepared. But when we talk about statement, profit and loss statement, income statement, so it has to be in a statement form. Like your bank account, when you open it, it will have a list of all the transactions with debits and credits on the right side, right? So a statement, your income statement, would not look like a T-shaped ledger. Rather, it would look like this: sales minus cost of goods sold, gross profit minus operating expenses, operating profit, add any non-operating incomes minus any non-operating expenses. This will give me profit before taxes minus taxes, profit after tax, right? And then after this, you'll have something called as other comprehensive income, which we'll discuss later on. Do not worry about it now. But yeah, see the difference between your normal account and a statement. I hope you are able to visualize that difference here in this particular topic, right? So a statement would look in a vertical format most of the time, and whereas in case of a ledger account, it is a T-shaped format. So the financial statements are what we talk about here, not your P&L account, trading account, and all that stuff. Financial statements. Now if I look at the first topic, so there are a lot of theoretical concepts that are added here in the material. So if I go through this line by line and explain you, that would not make much sense. So this is for the material is for your study purpose, not for my teaching purpose. So I'll only go through the keywords or the critical words in this. I'll not read the material line by line. It does not add any value addition for you. You can just download the PDF and read it out. I don't think the PDF would be freely available on YouTube yet. We'll think about it later on. But yeah, anyways, going back. So what are the 5 financial statements, sir? As we already covered earlier itself, but again I'm covering it formally. There are total 5 financial statements. 5 financial statements, most important one. They are the particularly significant ones. What are those 5 financial statements, sir? You can see here the first one is called as the income statement, or some people also call it the statement of comprehensive income. Some people also called it profit and loss statement. Sir, it's okay, you can call with alternative titles. So should I always mention as income statement? I'm used to calling it profit and loss statement. Is it okay? Yes, it is okay. But don't call it profit and loss account. Call it P&L statement, income statement, performance statement, or statement of financial performance. It's okay. All of them ultimately mean the same thing, so you can use alternative title. So what does the income statement usually consist of? So it shows the performance of the company. It shows the incomes, expenses, revenues, net profits, gross profit, operating profit, profit after tax, various levels of profits. We are going to discuss the meaning of each one later on. Do not worry. So you have your first statement, which is income statement, which talks about revenues, expenses, gains, losses of the company for a particular period. Sir, for a specific period. I want you to go back to your +1 materials and look at this meanings. So you might remember this from your +1. Whenever you used to prepare trading and P&L account, your heading was profit or loss account for the period something like 1st April 2022 till 31st March 2023. Whatever. If you are an Indian, you will use April to March. If you are in US, Jan to December. If you are in UK, whatever calendar 12 months you can take, like that. And if I talk about the balance sheet, so balance sheet as on end of the year 31st March 2023. Sir, why are you talking about this? We already know all this. No, you do not exactly know all the critical things that needs to be learned here. So the part which you usually do not pay attention in your +1 +2 is P&L account for the period. So usually a profit and loss is for a specific period, whereas balance sheet is as on a particular date. So when you say in the P&L, when you use the word sales, that means all the sales that happened between this start date and end date, all the sales for that period, for the period. Whereas when you talk about the balance sheet, you are showing as on a particular date. That means assets, liabilities, equities, all of this on a particular date. At the end of the year, what is the net position? We do not talk about all the changes that have happened during the year in the balance sheet. Balance sheet will show on the balance sheet date, on 31st of March, what is the position. We do not care about what was there earlier. Sir, now imagine the problem with this. I'll tell you a simple problem with this. My cash balance throughout the year, was $100, $500, $2,000, so on, so on, so on, less than $5,000 for the entire year. Exactly on 30th of December, that means one day before the closing of the balance sheet, on 30th of December, one fixed deposit got matured. We had a fixed deposit in the bank. It got matured on 30th of December. 31st is a holiday. We have nothing to do on that day. So on 30th, the last trading day of the year, last business day, functioning day of the year, we got a maturity of fixed deposit worth, let's say, $500,000. This is in cash right now. We do not have anything to do with that because that we got on the last day of the financial year. Now you tell me, sir, what will happen to the cash balance? The cash balance will show 500,000 plus whatever was there earlier. Throughout the year, your cash balance was only 100, 500,000, $2,000. Last day you got 500, but your balance sheet will show $500,000. That is the biggest problem with balance sheet. It is not a depiction of what is there throughout the year. It will only show you what is there on the last day, on the reporting date, on the balance sheet date. That is why the title is as on the balance sheet date. I hope this is all clear for you. So the profit and loss talks about your revenues, expenses, incomes, gains, losses for the period, throughout the period, specified period, whereas the balance sheet would only show you assets, liabilities and equities, assets, liabilities and shareholders equity on a particular point in time, at a particular point in time. It does not talk about for the period. It only talks about as on a particular day. Sir, what will be the use of balance sheet? We use income statement to understand the revenues, etc., etc., which is basically the performance of a company, right? Whereas, so you can see income statement talks about financial performance of the company. What does the balance sheet talks about? It looks at company's liquidity, solvency and overall financial health. What is your total assets? What is your total liabilities? What is the net worth of the company? It talks about financial position. So if I have to give you the proper names, alternative names, income statement talks about performance, financial performance. Balance sheet talks about financial position. That is why in UK, in IFRS, this statement is called statement of financial position, the balance sheet. Then you have something called as a cash flow statement. Sir, if you go back to your previous example that we discussed in balance sheet, where company is having a balance of cash balance of 100, 200, 500,000, 2,000, so on. Suddenly last day we got 500,000 and balance sheet is showing 500,000 cash balance. So shareholders will not understand what is the actual cash position. So they might get a little confused. They might not get the proper picture. So we go and prepare a cash flow statement. So cash flow statement, usually the name as it suggests, it is a statement that talks about the flow of cash. Sir, always read these words in reverse. You will get the meaning of that. Cash flow statement, read it in reverse. Statement, flow, cash. A statement that shows how the flow of cash is done in the organization. In short, from where are we getting the money? What are we doing with the money? What are the inflows? What are the outflows? पैसे कहाँ से आ रहे हैं सर, पैसे कहाँ पे जा रहे हैं, what are the inflows of cash, what are the outflows of cash. Okay, so inflow and outflow of cash within the company during a specific period. Again, cash flow statement for the period. In that year, all the inflows, in that year all the outflows. And sir, for further classification, to know what are each mode of transaction, we classify them into operating activities, investing activities, and financing activities. Details of this we will learn later on when we go into the cash flow statement. Okay, then you have something called as a statement of changes in equity. Some people also call this as shareholders statement, equity shareholders statement, which is okay, but the correct word, technical word, more accurate word would be statement of changes in equity. As again, read it in reverse, you will understand. It is a statement that shows how the equity is changing throughout the year. Equity means shareholders net worth or shareholders value. How is the shareholders value changing in that particular period? Again, this is also over a specified period. It shows whether the net worth of the company, value of the shareholders, is increasing or decreasing. What is the net worth at the beginning of the year? Let's say if I show you a simple glimpse of it, we'll start something like this. At the beginning, at the start of year, add net profit for the year minus any dividends distributed. This will give me what, sir? At the end of the year. This is only when I talk about your retained earnings. Again, what are retained earnings, sir? You might not understand it at this point of time. We'll discuss it later on. Do not worry now. So, what was the balance of retained earnings at the beginning of the year? How much profit or loss did we make in the current year? Did we distribute any dividends? Then, what is the closing balance of retained earnings? Similarly, equity is there. What is the total balance of equity at the end of the beginning of the year? Shareholders' equity capital, share capital, paid up capital, whatever you are calling it, common capital, whatever. What is at the beginning of the year? Add any new shares issued during the year, issue of shares, less any buyback of shares. In US, you have again treasury shares and all, which are not relevant in the first lecture. Do not worry. Then what is at the closing balance of share capital at the end of the year? So basically, we are going to show a reconciliation of the increase or decrease in the net worth of shareholders from the beginning of the year till the end of the year. Or if you are preparing quarterly, then beginning of the quarter till end of the quarter, whatever period you are preparing the financial statements for, no problem. See, basically the statements help you how the ownership interest of shareholders have changed over the time, whether the shareholders net worth is increasing or decreasing for that specified period. And then comes the most important statement according to me, which nobody actually pays attention to, that is notes to accounts. Sir, why, sir? Because notes, as the title itself suggests. Sir, if you already have a textbook, why do you use a notebook again? I have a very simple question. You all have textbooks with you. Why do you again use a notebook? In childhood, you used a notebook to write your notes, question and answers, important points, all this stuff. So basically, explanation to what is already given in the textbook, you take down in the notes, correct? Am I right? Explanation to something that is already there in the textbook, that is not sufficiently clear for you, so you are noting that down with explanation in your notebook. That is the exact purpose of notes to accounts. So in your profit and loss, we say sales. My P&L account is showing a word called sales. Sir, now I know that total sales are 5 million, but I would like to know what are the breakup of these sales. Suppose if I'm using a software company, sir, I am running a software company. Let's say Amazon, let's say Facebook, let's say Google, Alphabet company, whatever. They're running software services. So total sales are 5 million, which is okay. But how do I know the breakup of that? Let's say out of this, what is the software sales? What are the maintenance revenues that we are getting? What are custom contracts that we are doing with the customers? Any specific special design of design of a software or something like that, any server maintenance charges that you are collecting from your clients, storage cost like Google Drive, OneDrive, SkyDrive, whatever, there used to be different names for different things, Dropbox, etc., etc. So storage, cloud storage. So like this, I would like to know the breakup of that. I don't just want the 5 million sales, I want to know how much is from each variant. So I would have to go into my notes to accounts, which will then show me a brief a detailed classification and valuation of each item of the profit and loss and balance sheet, wherever required, not each item, wherever required. I hope that gave you more clarity about what is notes to accounts. So you can see here, notes to account, also known as footnotes or financial statements notes, are an integral part. Sir, notes to accounts are not optional, they are mandatory. They are integral part of the financial reports. They provide additional information and details of basically the explanation of the other information which is already presented in the financial statements. So already there in the textbook, you again write down with explanation in the notebook. Already there in P&L, balance sheet, cash flow statement, statement of changes in equity, you are again giving the explanation in the notes to accounts. They enhance the transparency and understanding of the financial statements. They provide more important context and explanation. So they give the further explanation and details. So my dear friends, that is your first topic, which is financial statements. So in short, you have 5 financial statements, which are income statement, which is also called as the comprehensive income statement. So this difference we will learn later on with the practical example. Do not worry now. Then you have the balance sheet, you have cash flow statement, you have statement of changes in equity, and notes to accounts. Income statement shows profits, losses, revenues, expenses, gains throughout a period, specified period. Balance sheet shows you financial position, assets, liabilities, and equities on a specified date. Cash flow statement talks about movement of cash, flow of cash, inflows and outflows, operating activities, investing activities, and finance activities. Then you have statement of changes in equity, which is the reconciliation of the shareholders' net worth at the beginning of the year and end of the year, listing out all the transactions with the equity holders. Then last you have notes to accounts, which is explanation to the elements which are already present in the financial statements, other 4 financial statements. So these 5 are together called as the financial statements. All right. So I hope all of you got an understanding about what are exactly the financial statements and what is the purpose of each financial statements. Further details we will discuss in the subsequent lectures. So I'll see you soon in the next lecture. Keep smiling. Take care. Bye bye. Radhe Radhe.